This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
A lot of people are online, listening to the radio, listening to all different kinds of resources that they can get their eyes, ears, and hands on, Abe, because all of the volatility we've been seeing, it's just the whole gold and silver conversation, I feel like kind of came out of nowhere all of a sudden these last few weeks.
Yeah, it's been a hot start to the year, let's say that. And some ups and downs.
We're off to a hot start, everybody.
Yeah, but gold and silver specifically, they've done really well, like in the last year or so.
Yep.
So, having that, retreat a little bit, having a reset, having a recalibration is not the worst thing in the world. I would compare that to the NVIDIAs and the Palantirs of the world that are just running hot like crazy. I mean, you can't make 200% every single year. Right. It's got to be some normal years. So I think those are all good things. Resets
are good for people like you and me. We're in the throes of our working years. You and I are mid-40s. We've got, time on our side. For somebody who is 60, 65, 70, who's getting ready to retire or just retired, to see this volatility can be unnerving, which is, of course, why you have a job, Abe, why you started Abich Financial Services, to help folks plan and prepare. So when volatility, not if it arrives, but when it arrives, you won't be shook to the core.
That's right. Having a plan for the ups and downs and expecting them,
That's right.
Because they're going to continue to happen. We have to. The markets just don't continue to go straight up.
That's right. And over the course of 20, 30-year retirement, you have to anticipate it. So working to build a plan around that anticipation is what Abe and his team are here to help you with. This year, it's not changing the story much in the stock market. There is still plenty of volatility, renewed concerns that the so-called AI bubble of stocks leading the way will burst. This is TIAA CEO Tashunda Brown Duckett recently on CNBC.
I think the real question is not knowing if it's going to burst or boom. It's about making sure you'll be prepared for retirement. And I think the most important thing is first to make sure you stay invested. Make sure you're diversified. It's not about timing the market. It's about how much time you put in the market. And as we think about that diversification, how do we ensure that there's income within it? Income has to be the outcome. And how do we make sure that you can have that guaranteed income that you can depend on month after month, regardless of what that volatility may look like?
Abe, Ms. Duckett says a lot of things that you constantly say here on this radio program every week. When people hear the word diversification, though, they often think stocks and bonds. However, when it comes to our retirement, we have to think about diversifying our income. So let's talk about the how-tos and benefits of that.
Income has to be the outcome. I love that, right? Because as we're getting closer and closer to retirement, obviously our wages, our paycheck at work is going to stop. It's going to end or be substantially reduced if we're going from full-time to part-time. And for a lot of people in their 60s, they're going to have to generate income for the first time in their lives. They're going to have to withdraw money out of their 401ks and IRAs and brokerage accounts for the first time in their lives when all they have ever known is putting money in. So if we're just constantly focused on rate of return and what stocks to pick and what funds to pick and what are the best funds for 2026, we are missing the boat. It's about having a complete, comprehensive plan, and a plan that obviously includes an income and roadmap to allow us to spend and enjoy the last 40 years of our work without the fear of running out.
Right.
So we don't want to rely on just stock market income in retirement. Like if it's all invested just in stocks and bonds, and a lot of times we see primarily stocks, and then we have that reset we just mentioned, that recalibration right at the point of retirement.
Yeah.
That retreat, from maybe a stock making 20 or 30% a year to now it's down 10 or 15% a year. If we lose 10, 20, 30% of our life savings, is it going to be able to generate the same income, for us over the rest of our lives that we could have had we not experienced that great of a loss? So we don't want to rely solely on income from the stock market. Obviously, that's not going to be as stable as we want it to be. We also want income that's going to complement Social Security. When you think about Social Security income, it's guaranteed. It's backed by the federal government. It typically goes up every year, adjusted for inflation. It's predictable, it's dependable, it's reliable. It's going to be there and should be there no matter what, obviously, unless something happens with the federal government. And that's the beauty of Social Security. It's going to pay you until you die, guaranteed and adjusted for inflation typically. You also want a retirement income portfolio that's going to manage longevity risk, right? A lot of our clients are going to live into their 80s, 90s, maybe even cross 100. And you need to make sure that income continues to last you, adjusted for inflation into your later years. And the benefit of all of that by having a retirement plan that's really designed to help someone in their 60s and 70s is a retirement plan that's going to be more reliable, income that's going to be more reliable, right? Again, if it's all coming from stocks, you know what that income is going to look like because the stock market goes up a lot and it can go down a lot.
Sure.
So having diversification for this new phase and season of your life is absolutely key.
Right.
We just helped a couple out of Frederick, Maryland, about $3 million saved, retiring in 12 months or less, concerned about generating income in retirement, really wanting to get after it in their go-go years, this next 10 to 12 years, between their early 60s and probably 75 is when a lot of people are going to do a lot of things and when you should really do a lot of things is get out there and travel and spend. Concerned about how to generate income, right? Again, this is one of the biggest challenges for so many people is that all they've ever known is saving, putting money into their life savings accounts, 401ks and TSPs, not taking it out. So that's daunting.
Yep.
And then concerned about, well, Abe, we've got $3 million. That's largely in part due to us being great savers, but also the markets being on our side. What happens if the markets take a dive right when we start taking money out? How can we plan for that, right? So the answer there and how we help them kind of put this all together and discover where they are today, where they were today, and all the things they needed to do to get to, in our opinions, a successful retirement plan was done through a portfolio X-ray and analysis and generating that income plan up front so they could see where all the income would come from. Number one, the portfolio X-ray tells you how you're invested today. Well, a lot of people head into their 60s, believe it or not, and they haven't made a lot of changes to their portfolio since they were in their 30s and 40s.
Right.
They're riding the stock market's highs. They're 80, 90% in equities and stocks, doing really, really well because the markets have done really, really well. But they're also sitting there, ready to take some potential big losses if the markets turn around. So if we have our number and this couple is $3 million is more than enough money to generate the income they need to have a successful retirement, why take on any extra risk than to accomplish our objectives?
Right.
So that portfolio X-ray helped them to discover how they're invested, all the pros and cons of it, what changes needed to be made, if any, and then that income plan. The income plan is going to give you the clarity you need. It's going to show you where all the income can come from. It's very simple, yet most people haven't had one put together.
Well, it's simple, but not necessarily easy. That's the difference.
Correct.
Yeah.
Correct. Yeah. And if you're not doing this all day long, maybe you're really good with Excel and can kind of put together your own, but wouldn't you want to have it tested and verified and measured by a retirement fiduciary that does this all day long, that sees these numbers all day long? Of course, most people probably would. So if you're listening right now and you're 55 years old and older, you've saved $500,000 or more in manageable, investable assets that we can help you with, we want to provide you the same reports, that portfolio X-ray and analysis coupled with that income plan so you can discover how you're invested and any changes that need to be made as you transition into what we call phase 2.
Abe, one of the things you just mentioned as far as how we need to plan for is the idea of our longevity in retirement because Americans, we are living longer and the latest numbers from the CDC are proving it. U.S. life expectancy rose to 79 years. That is the highest mark in American history. Life expectancy for women rose to 81.4 years. For men, that increased to 76.5 years. And living longer, it should be something that we think positively about, that this is great news. However, you got to remember that your retirement income needs to last 30 years instead of 10 or 20 years like it did for generations past. So what are ways that we can do better and avoid common mistakes? What are common mistakes that you see in regards to when people underestimate how long their retirement might be?
I think one of the biggest mistakes people make is not assuming that they are going to live long, especially if you're healthy and in your 60s. You probably will, which a lot of our clients are. So here are a few common mistakes from the article. People plan for averages, not possibilities. Meaning most retirement plans are built around average life expectancy, even though no one actually lives a, quote, average life.
Right.
The real risk comes from underestimating longevity and not planning for the very real possibility of living into your 90s. I can't tell you how many single women we meet with who are healthy in their 60s and their mothers are still alive. And a lot of our clients' mothers are in their 90s and still on their own, independently living, like at 94. I hear it all the time. So we need a plan for long life, especially you women, but also you men too. Life expectancy is the hardest number to estimate. Retirement planning can reasonably project income, market returns, and Social Security, but estimating how long you'll live is the biggest unknown. There's a lot of factors to consider.
Yep.
That uncertainty means people often save or withdraw based on assumptions that turns out to be too short-sighted. Healthier and wealthier retirees tend to live longer. People in good health, non-smokers, higher income households are statistically more likely to have longer lifespans. Ironically, those most prepared financially are often at the greatest risk of outliving their money if they don't adjust their planning horizon.
Yep.
This is one of the biggest fears, if not the biggest fear for people in retirement, is that they're going to outlive their money, meaning they're going to be 90. Their money's going to be gone. They're going to be 85, 95. And the money's gone and they're still alive. And I get that. That is a huge fear. And that's a fear we can help soothe by having a retirement plan that is tracked 4 times a year. You know, that's a typical amount of time we meet with our clients.
Okay.
We just helped a single female out of the Eastern Shore in Maryland, about 68 years old and healthy, does have family that lives into her 90s, over $10 million in net worth and savings just put away. Just wonderful job of putting it away. But one of her biggest concerns was that she wanted to enjoy her nest egg without the fear of running out. We put together a phase 2 retirement plan, portfolio allocation for phase 2. This is for someone in their 60s and 70s. Lowered the risk a bit, created a steady income plan with withdrawals that she can actually enjoy, right? So the money's coming in like clockwork. She can travel. She can take the trips. She can do the things she wants to do. Non-stock market dependent, right? Because the stock market, if it's all in the stock market, obviously that has ups and downs, and your income can have ups and downs.
Right.
Retirees need, want, and deserve stability of income, predictable income. This will allow them to book the trips. This will allow them to spend with confidence. That spending plan is absolutely key. If you're 55 years old and older, you've saved $500,000 or more in investable assets that we can help you with. We want to help you put together your own retirement income plan and roadmap at the point of retirement, or if you're retired, complimentary.
Abe, there's an article floating around online talking about a woman. She wrote into an advice column saying that waiting until 70 to take her Social Security was the worst decision of her life. So she's now getting over $5,000 a month. She would have gotten about half that had she filed at age 62. But she says it looks great on paper. The problem is that life isn't lived in monthly installments. She said, quote, I spent years telling myself I was being responsible by waiting, watching friends travel, and enjoying their early retirement while I kept working. Sure, my check is larger now, but at what cost? The money I'm finally receiving can't buy back the health and energy I had in my 60s. What can we learn from this woman's story, Abe?
Oh, heartbreaking.
I know. Breaks your heart.
That's heartbreaking.
Yes.
I see this so often that people think they need to continue working. Even for people that have a lot of money saved, they might think they need to work till 65, 68, 70.
Yeah.
They might think they need to delay their Social Security benefit till 70 to get the largest check. What if something happens in your 70s, right? What if something happens in your late 60s or early 80s? You're like, darn it, I should have taken this benefit early. I shouldn't have worked those extra 2 to 3 years.
Especially if you didn't have to, right? Yeah.
Yeah, especially if you don't have to. But how would you know if you didn't have a plan?
Right.
How would you know if you didn't have a fiduciary retirement planner that could really just assess it all for you and help you make the best decision? Because delaying Social Security is not always the best choice.
I know.
I had a gentleman walk up to me at one of our educational workshops years ago and was like, Abe, I always thought waiting until 70 was the best decision for everybody. But no, it is definitely not. In fact, you better have your math worked out really well, and you better live a long time to wait until 70. Yep. While waiting until 70 maximizes monthly benefits, this lady regrets missing out on years of experiences. Health and energy in your 60s can be worth more than a bigger check later.
Yep.
That's pretty obvious, but maybe not obvious to everybody. Opportunity costs matter. She watched her friends travel and enjoy early retirement while she continued to work. That extra income now can't buy back lost time. Yep. Underscoring that financial decisions should balance money with lifestyle goals. That lifestyle plan and everything you want to do with your money is absolutely key. And we help our clients with that as well, that lifestyle plan. Well, we just helped a lady that lives in Loudoun County, where our office is headquarters, but also Florida. She goes back and forth. and she's got about $5 million. And she did wait until 70 to take Social Security.
Okay.
And one of the biggest reasons why she came to us, she was actually working with what we call a phase 1 financial advisor for a long time. And he was doing a decent job for her. But she waited till 70 to take Social Security, and she felt like she wasn't truly enjoying her life savings. Like, a lot of advisors will say, don't take out so much money, and maybe you should work another 3 to 5 years.
Yeah.
And it's kind of backwards thinking in our opinions a lot of times. And so while the advisor had done okay, returns were decent, the advisor was also reactive versus proactive. And the discussion was really a lot based on rate of return and how the investments were doing versus the whole plan, right? The healthcare plan, income plan, tax planning, estate planning, and all of that, which is so important. So we ran an analysis for her, a retirement analysis and an income analysis for her on all of her holdings, her entire net worth, entire financial plan, and came up with a retirement income optimization report. And we want to offer that now to any of you that are 55 years old and older. You've saved $500,000 or more in investable assets we can help you with. We want to offer you that same retirement income optimization report that we offer to this 70-year-old lady.
Abe and his team, they are here to help you do that. So it's theretirementkey.com to start the conversation, or you can just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abich Financial Services, visit theretirementkey.com. And join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m. Abish Financial Wealth Management is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. The information contained in this material is intended to provide general information about Abish Financial Wealth Management and its services. It is not intended to offer investment advice. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Information regarding investment products and services are provided solely to read about our investment philosophy and our strategies.